Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so on Friday, February 6, 2026, ASML Holding. It closed on Euronext Amsterdam, a 1,193 euros and 80 cents. That's up about 3.84% on the day, with volume around 545,000 shares. And if you look at the NASDAQ ADRs, they closed at $1,413.01. This caps a 52-week run that's gone from, a low of roughly $578 to a high of nearly $1,500.
It has just gone vertical. An absolutely vertical climb.
Vertical is an understatement. We did see some volatility leading up to this, specifically that sharp 4.18% drop on February 4th. Most people chalk that up to profit-taking, but the recovery was, it was almost immediate.
It is immediate, yes, but let's be precise about what we're looking at here. ASML has hit what the market's calling an inflection point, supposedly driven by this AI supercycle. So the central question we really need to wrestle with today is this stock a continued buy because of its absolute monopoly on extreme ultraviolet lithography, or EUV, or is this a classic bull trap that's just trading in significantly overbought territory?
It is absolutely the former, and I don't say that lightly. My stance is that ASML has proven itself to be the essential gatekeeper of the digital age. I mean, the premium valuation we're seeing, it's fully justified by its monopolistic power, and more importantly, that massive 13.2 billion euro bookings record we just saw. This isn't hype, it's infrastructure.
And I come at it from a different angle. I believe the stock is priced to perfection. We are looking at a price-to-earnings ratio, a PE of over 50. You've got structural headwinds in China that are not going away, and maybe most tellingly, there's a complete lack of any recent insider buying at these levels. The company is fantastic, but the stock price just assumes a flawless execution that, history suggests is pretty rare.
I see why you think it's priced for perfection, but let me give you a different perspective based on the Q4 2025 earnings report from January 28th. This wasn't just a beat, it was a game changer. The market was expecting a standard quarter, maybe even a cautious one given all the geopolitical noise. Instead, ASML delivered record net bookings of $13.2 billion. That is nearly double what the market was anticipating.
It was a significant number, I'll grant you that, but numbers without context can be dangerous.
Well, the context is even better than the headline. Of that $13.2 billion, $7.4 billion was specifically for EUV systems. And for listeners who might not be deep in the semiconductor weeds, EUV, extreme ultraviolet lithography, that's the only way to print the most advanced chips used for AI. This backlog number confirms that the hesitation we saw in 2024 and early 2025 it's over. Management raised their 2026 sales guidance to a range of $34 billion to $39 billion. The thesis here is simple. The AI supercycle is real, it's capital intensive, and ASML is the only company on earth selling the shovels for this gold rush. The recent price surge isn't a bubble, it's a rational re-rating of future earnings potential based on that backlog.
That's a compelling argument, sure. The backlog is compelling, but if you looked at the technical cost of this rally, the stock is currently overbought on the RSI, the Relative Strength Index, which measures the speed and change of price moves. It's screaming caution. We're trading significantly above the 50-day moving average of $1,187 and the 200-day average of $991. When you have a vertical move of 30% in January alone, the market has already digested the good news.
Momentum often looks like overextension until the fundamentals catch up.
But the fundamentals have cracks. Look at the China headwind. We know from the guidance that demand from China is projected to drop to only 20% of sales in 2026 because of export restrictions. That is a massive revenue hole. You're asking investors to pay between 48 and 55 times earnings for a company that is legally barred from selling its best products to one of the world's largest markets. Any execution slip, and that includes the integration of the new Heine machines, it could trigger a correction that takes us right back to that 200-day moving average very, very quickly.
I'm just not convinced by that line of reasoning because it ignores the comparative landscape. Let's talk about that valuation gap. You mentioned the 50x PE. And yes, ASML's market cap is hovering around $560 billion, which just dwarfs peers like Applied Materials at $256 billion or Tokyo Electron at $122 billion. But comparing them directly it's a category error. You can't value ASML like a standard hardware cyclical.
Why not? They build machines, they ship them in containers, it's hardware.
Because ASML operates more like a software monopoly than a hardware manufacturer. Think about the dynamics. Applied Materials and Lam Research, they face competition in deposition and etch, steps in the chip-making process where you add or remove materials. If a fab manager gets frustrated with Applied, they can call Tokyo Electron. They have options. But if they need high-end lithography to define the transistor patterns, there's no one else to call. Nikon and Canon, they got out of the high-end game years ago. That lock-in commands a premium. Just look at the EBD gap. ASML is at $12.4 billion compared to KLA Corp's $5.56 billion. The market pays for certainty, and ASML offers the only certainty in the front-end process.
I'm sorry, I don't buy this software monopoly comparison. Software has zero marginal cost of replication. If Microsoft sells another copy of Windows, it costs them nothing. ASML makes machines that require 40 shipping containers to move. They deal with physics, supply chains, thermodynamics.
But the revenue recurrence.
Let me finish. Sticking to the valuation, a P of 50 is dangerous compared to Tokyo Electron at roughly 32 or Applied Materials at 37. These peers are also essential. You can't build a chip with just lithography. You need deposition and etch to actually build the structures the light draws. And when the spread between ASML and the rest of the wafer fab equipment, or WFE sector, gets this wide, it usually reverts to the mean. Investors eventually realize that the whole ecosystem needs to grow, not just the guy with the stencil.
But the others aren't the bottleneck. ASML is a bottleneck. The pace of Moore's law, the doubling of transistors on a chip, is dictated by the wavelength of light that ASML can harness.
Being a bottleneck is a double-edged sword. It means you're also the single point of failure. Which brings us to the technology itself. You mentioned high-NA EUV.
Exactly. The transition to high numerical AUV, that's high numerical aperture, is the next leg of growth. Without getting too bogged down in the physics, this technology basically increases the aperture of the lens to 0.55. It allows the machine to draw much finer lines, enabling denser, more powerful chips for AI. And these machines cost over $400 million each. Intel has already been identified as the early adopter to try and reclaim foundry leadership. And crucially, revenue recognition for these systems began in Q4 2025. That signals that the commercial entry of the technology is successful. The risk of will it work is gone. Now it's just about scaling.
Is the risk really gone? I look at the margin impact. I mean, despite those record bookings, the company announced 1,700 job cuts in tech and IT on January 28th.
That's efficiency, not weakness. CEO Fouquet called it necessary agility.
I view it differently. When a company cuts 1,700 highly skilled roles right as they're ramping up the most complex machine in human history, it suggests they are desperate to protect margins. This streamlining frames a need to prop up profitability because the Heine ramp-up is more capital-intensive than they let on. It's a Rube Goldberg machine business model. You're vaporizing droplets of tin with a laser to create plasma that emits extreme ultraviolet light, which is then bounced off mirrors, the smoothest mirrors ever created, all inside a vacuum. If one supplier delays a lens or a sensor, those 40 shipping containers sit idle. At a $560 billion valuation, the market is pricing in zero delays.
The complexity is the moat. If it were easy, China would have done it by now. The job cuts are about hitting that 2030 target of $44 to $60 billion in revenue. You trim the fat to build muscle. And speaking of muscle, look who's holding the stock. The institutional flows tell the story. Smart money support is rock solid. BlackRock and Vanguard are holding steady, but look at the smaller, more agile funds. Access Wealth increased their position by 381%. Investmark Advisory added 133% in early February. They're chasing this for a reason.
You're looking at the buyers, but you're ignoring the sellers. And this is my most crucial counterpoint. Insider behavior tells a completely different story than the institutional flows.
Management is holding significant equity. They're aligned with shareholders.
Holding, yes. Buying, no. There's a massive difference. The cluster of insider buying, CEO Fouquet, CFO Dawson, that happened back in September 2025. Do you remember the price back then?
It was obviously lower.
It was much lower. Directors were buying in the $244 to $282 range. We are now over $1,400. And since that September cluster, there's been silence in 2026. No open market buying from top execs during this entire rally. In fact, CEO Fouquet actually sold small amounts, about 995 shares, back in February 2025.
That is a tiny fraction of his holdings.
It's the signal that matters. If the people running the company aren't buying at $1,400, why should the listener? If they truly believe this was just the beginning of the AI supercycle and the stock was going to $3,000, they would be buying or at the very least not selling.
Executives sell for tax reasons, for diversification, all the time. The lack of buying after a 100% run-up isn't bearish, it's standard portfolio management. What matters is the buyback. The $12 billion share buyback program puts a floor under the stock price that insiders don't need to replicate personally. The company is buying its own stock. That is the ultimate insider vote of confidence.
A buyback supports a stock, but it doesn't signal conviction and valuation the way personal capital does. A company buys back stock to manage earnings per share, EPS. An individual buys stock to make money. And we had to talk about where that future capital is coming from. We touched on China, but I want to drill down on the numbers. Going from a front-loaded 2024 and 2025 where China was a massive chunk of revenue, sometimes 40–50%, down to only 20% of sales in 2026 is a structural shift.
It is a shift, but it's a shift of quality. The Chinese demand was largely for older, less profitable immersion lithography machines. The new demand is for high-margin EUV.
It's a loss of volume. And there's the long-term existential threat. You see it debated on forums like R-Value Investing constantly. The China Moat debate. By locking China out, we're forcing them to innovate. If China is forced to reverse engineer EUV because they can't buy it, that creates a competitor where there was none. It might take a decade, but at these valuations, we're betting on the next decade.
That's a fascinating theoretical risk, but let's look at the reality of 2026. The loss of Chinese volume is being more than offset by global demand for EUV tools driven by AI. The AI supercycle requires more complex layering. That means higher lithography intensity per wafer. You don't just need one pass with the EUV machine, you need multiple passes to create the 3D structures of a modern GPU. That multiplies the demand for tools even if the total number of chips stays flat.
So the argument is that AI just solves everything?
In this case, yes. AI chips are large, complex, and yield-sensitive. That is ASML's sweet spot. Recent analyst upgrades reflect this. Alethea Capital moved from sell to buy recently. That signals capitulation from the bears. When the skeptics throw on the towel, the stock usually has more room to run.
Or it signals the top. When the last bear turns bullish, there's no one left to buy. That's classic contrarian investing.
I disagree. The backlog of 38.8 billion euros provides unmatched visibility. We know what they're going to earn for the next 2 years. In a volatile tech market, that visibility is worth the premium. You aren't guessing if they'll sell the machines. The orders are already signed.
Visibility on revenue isn't visibility on profit margin, especially with the high-NA transition costs we talked about. But let's step back. We agree the company is a powerhouse. The disagreement is the price tag.
The price tag reflects the monopoly. You can't buy a discount version of ASML because one doesn't exist.
Fair enough. Let's wrap this up. I just want to reiterate that while ASML is a great company, the stock is currently a crowded trade. When you have a PE of 55, a vertical chart, and insiders who bought at $250 refusing to touch it at $1,400, you have to be careful. The structural decline in China revenue is a reality that the AI hype is currently masking. If that AI narrative cools off even slightly, that PE compresses and the stock drops.
And I'll conclude by saying that ASML is a buy because it's the infrastructure play of the decade.
That $38.8 billion backlog is money in the bank. The monopoly on EUV is the bottleneck for the entire global AI infrastructure. From NVIDIA to TSMC, they all wait on ASML. The job cuts show management is serious about margins, and the technical breakout is supported by massive institutional accumulation. You buy the leaders and you don't bet against a monopoly during a technological revolution.
We can agree that they're the quiet power behind the AI boom. Without ASML, there is no NVIDIA GPU.
Absolutely. But we disagree on whether the current $1,400 plus entry point offers any margin of safety.
I see risk, you see opportunity. For our listeners, keep an eye on that 50-day SMA at 1187. If it tests that level, we'll see if the bulls really have the conviction they claim.
And watch the booking numbers in Q1. If they stack another massive quarter on top of this one, $1,400 will look cheap in hindsight.
Time and the market will tell.
That's all for today.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.